Good evening, everyone. Welcome to part 2 of our Investors and Investment Masterclass. The last time out, we had a very good time together laying the groundwork for who an investor is and what an investment is. And today we want to go a notch higher in our understanding of the concept of investment and the investor. So today we're going to go into paper assets. The focus of today's discussion is paper assets. Remember I told you that investment can go in different directions. An investor can build a company, an investor can buy real estate, an investor can invest in commodities, an investor can acquire paper assets. So today we want to look at the paper assets that investors use to make money. I said this during the last video, and I'm going to reiterate it again, particularly today, that the richest people in the world play with paper assets. When Forbes is determining how rich or high net worth people, one of the things they look at is how much stock holding they have in companies that they own and the market value of those shares. Elon Musk became the richest man in the world because Tesla's stock, SpaceX stock skyrocketed. Okay, so we want to look at how the stock market works and all other details. So when we talk about paper assets, we're talking about stocks. We call them equities, financial securities. Then we also talk about bonds. We talk about mutual funds. We talk about exchange traded funds. We talk about commercial papers. All right. And they offer a very good means of getting a lot of passive income. During the last session, we talked about what passive income is all about. I don't want to spend a lot of time on the matter of passive income, but just for the sake of clarification and for the sake of knowledge, passive income is that income you earn by the side. It's not something you do. It's not income that comes from something you do actively. It's just something that brings money because of the fact that you have put money into an investment vehicle, and then that investment vehicle now makes returns for you on a monthly basis, on a weekly basis, on a quarterly basis. That's why it's called passive income. You are not actively involved in the day-to-day generation of the money through that investment instrument. I think that is clear enough. We don't want to spend a lot of time on the issue of passive income. We have done a lot on passive income during the last time. Investment types and their risk levels. One of the things you need to realize in investing is that the higher the risk, the higher the reward, right? So if you are very averse to risk, then you are simply saying that you don't want to make a lot of money. Because one of the things an investor must have is a large heart or a large stomach for risk. Your risk appetite has to be significantly good if you're going to make good money using paper assets. So when we talk about the paper assets, I mentioned some of them before. I'll go into the risk level of all the paper assets I had mentioned before. Mutual funds, another name for mutual funds is collective investment schemes. Mutual funds are not as risky as stocks. Why? Because what happens with the mutual fund is different individuals, retail investors, sometimes institutional investors, commit their money collectively with an asset management firm. This asset management firm now gathers this money and invests it sometimes in some select group of stock. All right. Most times they use diversified portfolio to minimize their risk. Okay. So these investment managers or asset managers now invest this money on behalf of the people who have invested in the mutual funds, and then promise them a return. And for instance, I do mutual funds. One of the things you find in the mutual fund form is they will tell you the different investment instruments they are going to invest your money in, and they will tell you this is the return on this is the risk on this, and then they'll ask you if you have a low risk appetite, go for the lower the one with the lower risk. Of course, that one with the lower risk will give you a lower return. And then they also tell you that the one with the higher risk will give you a higher return. All right. But the good thing about mutual funds is that the people investing your money are people that are very experienced. They understand how the market works. You know where to put your money, and they give you a guaranteed return every quarter, depending on the performance of the funds where they administer your funds. All right. And then closely related to mutual funds is the exchange traded funds. In fact, some of the mutual funds actually put your money in exchange traded funds. Exchange traded funds are funds that are traded on the floor of the secondary market, of the capital market, right? So that is also less risky, all right? And like we said during the first session that we had on investment, Robert Kiyosaki made a very profound statement. He said, no investment is really risky. The person that is risky, or what is risky about investing, is the investor. And the way to eliminate risk in investment is to acquire financial literacy, acquire the financial knowledge, know how the instrument you're investing in works, understand the dynamics of it. And then by the time you understand the dynamics, you have all the knowledge you need to have. You are mitigating your risk. Risk mitigation is down to knowledge acquisition. The difference between the very successful people financially and their age mates that are not successful financially is what they know, what they have upstairs. It's a knowledge gap that creates the wealth gap. The wealth gap we find in society today is actually a knowledge gap. And that's why very successful people spend a lot of time acquiring knowledge, reading books, attending seminars, attending conferences to sharpen their financial knowledge. All right, so mutual funds, exchange traded funds are less risky. Okay, then if you go further down, bonds are also less risky because bonds are guaranteed by governments most of the time. And then, of course, private corporations also issue bonds when they want to expand and want to raise money without diluting their ownership. All right, I'll give you more detail in a couple of minutes on the details, the more technical details about bonds. Bonds are long-term investment instruments. So a bond can last for 5 years, for 10 years, for 20 years, you know. But what is important and what is good is that the bond gives you a fixed income. So they are fixed income instruments. They have less risk because they are guaranteed by government. I strongly recommend you do bonds, okay? Rather than put money in the bank, better put the money in bonds, all right? It's a better place. The federal government bonds that was launched last year is about 19.25%, if I'm not mistaken, which is a very high yield. All right, so you can put your money in that FGM bond. It's guaranteed by the government of Nigeria. So you can't go wrong buying a government bond. All right, private corporations also give bonds. All of that we shall discuss. And then you talk about stocks, okay? Now, stocks are more risky. Stocks are more risky. So out of this, out of the previous three I've mentioned, plus the stocks is the riskiest of all of them. Why? Because now there are two ways to go about stocks, all right? You can be the player yourself when it comes to buying stocks, or you can get your stockbroker to do it for you, or you can get a financial advisor to trade for you. You can get your stockbroker and get his advice. I give you an example. There are so many platforms. I subscribe to many platforms that give you very good ideas on which stocks to buy, which stocks to sell, which stocks to hold. All right, there are three positions you can adopt when it comes to stocks. You either buy, or you sell, or you hold. All right, when you talk about holding, it means you have a stock that you shouldn't sell because it has potential for maybe capital appreciation, or it has high dividend payout capabilities, or the company has a history of giving bonus shares and things like that. So you hold. So you find much stockbrokers advising you, don't sell this stock, hold it. And then there are stocks that you talk to them, you say, sell this, the price is coming down, or there seems to be a crisis with the company and all of that. Okay, so stocks are risky. So you need to have a lot of knowledge. And I want to say this so that you understand what we're talking about. Stocks are risky, but like I said earlier, if you have the knowledge, the requisite knowledge, you mitigate the risk involved in investing in stocks and buying stocks and shares. All right. So let's quickly go into equities, which is the major focus of our conversation today. The stock market has made a lot of millionaires. I heard a story many years ago. Let me tell the story very briefly. A friend told how they went to Lagos, and they see some old retired Yoruba men. They do nothing but read newspapers every morning and listen to the news every morning. And they see these men drive very flashy cars, live in very good houses, have a good life. They don't see them go out in the morning hustling. They don't see them go out in the evening doing a second job or whatever. They are comfortably retired. And so one of the days he got curious and he spoke to one of the babas, in his words. He said, "Baba, why is it that every morning I just see you just bring the newspaper and you are just checking the newspaper? I notice it's a daily routine." And the baba smiled at him and said, "I am checking the performance of my business." And the young man was curious. He said, "Oh, you own businesses that are on the stock in the newspaper?" He said, "Yes, I own shares in a lot of companies. I'm a part owner of those companies that I own shares in. So I am checking the performance. I'm checking the share price of my shares. I want to know which one is doing well and which one is doing badly. I want to know whether I should go and call my stockbroker and sell off this one for me or buy this one for me." "Daddy, so that's what you do every day?" I said, "That's what I do. I just monitor my stocks and I see the one that is doing well and I see the one that is not doing well, and I know I make a decision based on my knowledge whether I should buy or I should sell, I should do whatever." All right. And so it was an eye-opener for the young man, because the young man is from the southeast of Nigeria, where the Southeasterners are known for trading, for business. All right. And then he was looking at those Yoruba men as lazy people that would just sit in the house. Unknown to him, those men had laid solid foundations for wealth when they were much younger by investing massively in the stock market. You see multi-millionaires who don't really have physical or what you call active businesses, but they are bought into thriving businesses, Fortune 500 companies, like we call them, companies that are listed on the stock market. And the dividends, the payouts, the capital appreciation from those shares is what they use to run their daily lives and their families very comfortably. So this is a very, very important sector. It has its own risks, which I talked about. But why we're having this session is to show you how to avoid the risks. And so you can be a player yourself. All right. So equities is another name for stocks, all right, or ordinary shares. All right. They are usually issued by companies to investors. I'll give you examples of companies that are issuers. Think of all the big companies in Nigeria: Dangote Cement, Boa Cement, all the banks, the big banks in Nigeria. Virtually all the banks, except for one or two, are quoted on the stock market, on the stock exchange. These are very big companies. You have different industries, sectors within the stock exchange. You have the industrial goods, you have the fast-moving consumer goods sessions, Unilever, Nestle, and the likes. You have the banking sector. You have the telecoms. Recently, MTN, I think a few years ago, MTN got listed on the stock market. MTN shares have gained massively. Those people that were fortunate to buy MTN shares back then when they came out for their IPO, many of them have become very, very rich today. Those that were able to get substantial amounts of it. Okay, so shares are issued by companies to investors. All right, and when these companies issue these shares, what they are doing is that they are offering those investors an opportunity to be part owners of their business. All right. Now, the goal of a company issuing her shares is to raise capital, to raise funds. All right. That's why it's called the capital market. These shares are sold on the floors of our capital market, on our stock exchanges. All right. I'm going to go through the two aspects of the market later, the primary and secondary market. Now, these stocks and equities give the investor part ownership of the company. So if I buy shares of Boa Cement, I become a co-owner of Boa Cement, as long as I hold on to those shares of Boa Cement. If I buy shares of Dangote Cement, I become a part owner of Dangote. Is that not interesting? Is that not fascinating? So it's such a very wonderful opportunity, and a lot of us need to start playing in that space. Now, this investment into this company gives you access, or gives you the privilege of earning what we call dividends. Dividends are are proceeds from the profit made by the company at the end of their financial year. All right. So at the end, when you buy shares of the company uses your money to do business. After 1 year, they show you appreciation for investing in them by what? Paying you dividends. All right. They pay you dividends. Now, some companies also pay dividends more than once. Sometimes most times they pay dividends at the end of the financial year. Sometimes companies don't pay dividends. Sometimes they give bonus shares. They say, okay, the money we made, we want to reinvest it in another business. During their AGM, what is called the annual general meeting, they invite the shareholders who have voting rights. The board members sit on the table and they address all their shareholders and tell them, this is what we have done. This is the performance of the business for 1 year. This is how much we have made. This was our operating expenses. These are the supposed earnings per share. However, we want to build a new factory in Kano, right? We made a profit of 30 billion. We want to build a factory in Kano that will cost 40 billion. So the shareholders will now decide and say, okay, since we have a deficit of 10 billion, we want to build a factory that will cost 40 billion. Don't pay us dividends, give us bonus shares, or defer the dividend payment to another time. So the AGM will now make a decision and agree on what direction to go, whether to give bonus shares or to give 1 for 1 or 1 for 3 or 1 for 2 and all those dynamics. All right. So the bottom line is, being an investor in a company that issues shares entitles you to dividends and bonuses that are declared by the company at the end of the business year. All right. Companies issue shares through IPOs. IPOs is initial public offering, and that happens in the primary market, or through rights issues. All right. Rights issues. When we talk about rights issues, what happens with the rights issue? Like what happened recently with the banking sector. The CBN directed banks to shorten their capital base. And so most banks, a good number of banks rather, have come to the capital market to raise funds. Okay. So many of those banks, because they're already quoted on the market, many of them did rights issues. So existing shareholders have the right to buy. They have a preferential advantage to add more shares to the ones they already have, right? Or sometimes they do it proportionately. So for every 2, you can buy 1 extra, like that. Or they do an IPO, or do a public offering rather, not an IPO, because they are already old companies. They do a public offering. So people who are not shareholders before can now come and become shareholders and come and buy shares. Okay. Then people who are existing shareholders also get a rights issue, so they're able to acquire more shares in addition to the ones they already have. I believe that is very clear. So offering existing shareholders ordinary shares in proportion to their share holding. All right. So I talked about bonds earlier. Bonds are debt instruments. Okay. They enable companies to raise money without relinquishing any ownership, without diluting their ownership to the bond buyers. So to put it very succinctly, if a company goes to the capital market and issues bonds or puts up their bonds for sale, and you buy the bonds of that company, it doesn't make you a part owner of that company. That's the difference between bonds and shares. Okay. Another difference between bonds and shares is that bonds have fixed income. All right. Unlike shares, you can buy a share for 5 naira and in 2 months the price appreciates to 15 naira. That means you have had capital appreciation of 10 naira. All right. But with bonds, at the point of investment, the value of money you are investing will be used to calculate how much interest you are going to make on that investment. I give you an example. I told you of the FGM bond. The FGM bond gives us an interest, quarterly interest of 19.25%. I hope I'm correct with that figure. 19.something%. Okay, so it is fixed. So if you invest 2 million naira, for instance, it is 19.25 or 19 point whatever percent of that 2 million that you will receive, quarterly, until the money you invested is liquidated at the end of the tenure of the bond. I remember I mentioned that bonds are long term. Okay, so a bond can be for 5 years, for 10 years, and is meant for, most times, when, like the federal government bond, you want to use it for infrastructure. You want to use it to build roads, build bridges, build rail lines, and all of that. Okay, so they are long-term instruments. They usually pay quarterly interests. All right. Now, when a company issues bonds, they are called, another name for corporate bonds is debentures. All right. So if a company issues bonds to the market, you don't just call them bonds. Or you can call them corporate bonds, or you call them debentures. All right. So we want to talk about the primary market, and we are moving pretty fast because we want to get to the nitty-gritty of the investment in shares. How do you go about it? The primary market, the capital market is divided into two segments. You have the primary market and the secondary market. Okay, the primary market is the segment where fresh issuance of securities happens. So a new listed company in the stock market, all right, the company that wants to go public, when they offer their shares for sale for the first time, they go to the primary market. The proceeds that come from that offering goes directly to the company. All right. So they go to after they go through their whole process, I'm going to explain in greater detail the fine details of the process, how companies go around getting NGX to enlist them, or rather to enlist their shares to do their IPOs. Okay, so the companies that issue instruments are called issuers. So, for instance, I think UBA is currently offering their shares for sale. I think they are doing both a rights issue and a public offering. I hope I'm correct on that too. So, in that situation, the company issuing the shares, which is UBA now, is called the issuer. Okay, the company is issuing their shares for sale is called the issuer. Now, before a company can go and issue their shares to the public in the stock market, they must get approval from the board. All right, the board, the management board of the company, the board that runs the business, must give approval, must assent to that decision, and then this approval will be communicated as a board resolution and sent to SEC. SEC is the Securities and Exchange Commission. SEC is the government body that regulates all the operations that go on in the Nigerian stock market, in the NGX. Okay, so companies get approval from their boards and convey the same approval through a resolution to SEC. SEC will now give approval for them to commence the process. The company will now approach what is called an issuing house. Right? There are so many issuing houses in Nigeria, Vertiva Capital, Meristem, and the likes. Now, these issuing houses will now package the public offering, package it. It's a marketing device. You want to make it appeal to the public. You package it well. The same way a young man packages himself when he wants to go and meet a young lady he wants to marry. That's the same way the issuing houses will package the offer. They will make the image of the company look very nice. They will do a lot of work to make package it very well so that the public will be interested in it, right? And then the issuing houses and other parties that are involved in the whole public offering will prepare what is called an issue prospectus. All right, it is that prospectus that most of us get to read before we invest in the company. So they prepare a prospectus, and the prospectus contains quite a lot of information. It contains the financial trajectory of the company, the growth trajectory of the company. It will contain the management structure of the company, because you see, one of the things that boosts the confidence of any investor in a company is the quality of the people managing that company. So the prospectus will feature the profiles of the people who run the business. All right. For instance, if you read an issue prospectus and on the management board you see Dangote's name there, what would that do to your confidence? You say, no, this has to be a good buy. Am I correct? It has to be a good buy. You see Dangote's name, or you see a Tony Lumelu's name, or you see all these very high class people. So that is what the prospectus will do. It will package it. It will show you why the company is a good company. To show you why you'll be missing an opportunity if you don't invest in that company. All right, and then SEC gets they prepare the prospectus, and then they get approval of SEC. I've told you what SEC is, Securities and Exchange Commission. SEC will give the approval, and then they can now go to the public and tell the public, see, this is what we are giving to you. This is the opportunity we are offering to you. All right. So when they now go to the public, interested investors will now purchase the shares. All right. Purchase the shares through the collecting agents. All right. In the case of the recent banking offerings we have been seeing, most banks use their bank offices as collecting agents. I remember when I bought Fidelity, I bought it through their branch here, where I live, in the city where I live. So banks use, some of the banks, around, they use their offices as collecting agents, and then they use their staff as marketing agents to market the offering they're giving to the public. But apart from banks being collecting agents, stockbrokers can also serve as collecting agents. All right, stock brokerage companies actually. Now, at the close of the IPO, the monies, the proceeds from the offering is received and passed to the issuer. That's the company that issued the shares. All right, at the close of the IPO. Don't forget, these offerings have a timeline. All right, it will run from 2nd December to 2nd February. Usually lasts a bit of time because you want as many people as possible. Of course, depending on the number of shares you want to even sell, authorized shares you want to sell. All right. So you want to sell 20 billion shares. You want to sell 1 billion shares at 5 naira per share. Shares of 50 kobo at 5 naira per share. Depending on the volume of shares. So you want to, if you want to do 5 billion shares, for instance, or 2 billion shares, the issuing house, the banks, or the company, and everybody involved, the parties to the offering, will sit down, do their technical analysis. Will we be able to sell 1 billion units of our shares within 1 month? If the answer is no, then they factor that into the duration of the offering. So they can make it for 90 days, they can make it for 60 days, whatever. The bottom line is they want to make sure they're able to sell all the shares or sell as much. Usually they have a target. And then sometimes you hear them say their shares were oversubscribed, right? So they put out 2 billion units of shares and they sold out the 2 billion shares and people were still requesting for more. All right, so that's when you hear oversubscription of shares. The shares were oversubscribed. All right, where they put out 2 billion units and they were able to sell only 1 billion, you say it was an undersubscription. All right, so I think that is very clear. So the issuers receive the money at the close of the IPO or the rights issue or the PO, and then they receive it and they pay all their fees and all the commissions. Of course, the issuing houses, the registrars, all the parties to the enlistment of the shares will earn a commission and they charge a fee for their services. So by the time they deduct all those fees, all those things, they now take that capital and then they begin to invest it. All right, they invest the money the way they had told us they are going to invest it in their prospectus, the issue prospectus. Okay, so they trade with it for 1 year, and then at the end of 1 year, they publish their financial report for the year, and then they will tell you whether they made a profit or they made a loss. Okay, if they made a profit, then they will tell you they will pay you dividends per share. Right? Recently, I looked at the 2022 financial report for Zenith Bank, and I saw earnings per share. They were saying 7 point something naira. That's a good return, earnings per share for them. So some companies, make no mistake about it, some companies at the end of the year record losses. If they record losses, what are they going to give you? They probably not have anything to give you. They might just give you bonus shares and all of that. So that's why you need to understand the technicalities of investing in companies. All right? And then investors are rewarded with a share of the profits in the form of dividends or bonuses or both. Some companies are very generous. They give you dividends, they give you share bonuses. Sometimes they do both. Some companies even do 2 dividend payouts in a year, in a financial year. They do what is called interim dividends, and then they do year-end dividend. So you can see that it's a very good way to go. It's a good way to look. The secondary market is where those who played in the primary market continue to now transact the shares they have already acquired. Let me explain what I'm saying. When you watch stock market reports and you see the price of First Bank went up, the price of Zenith Bank went up, the price of X went down, it is because of the activities that go on in the secondary market. So Mr. A bought 20,000 units of A PLC, right? And then the price went up to, he bought 20,000 units at 50 naira per share. And then 6 months later, the price went from 20 naira per share to 50 naira per share. And Mr. A says, this is a good opportunity. My 20 naira has turned to 50 naira times 20,000. So I'm leveraging 30 naira in 20,000 places. That's a lot. I need that money now. Let me collect it. So Mr. A approaches his stockbroker. I'm going to get into detail. So that process I just described to you is what happens in the secondary market. All right. So that is that. Now, we want to go into buying and selling of stocks in the secondary market. How does that happen? The step-by-step process. All right, in the secondary market. So the first thing that happens is, let's say I see, or I have a particular, like the Mr. A I cited earlier. All right, 20,000 units of company A, the company A PLC. All right, I want to sell. Price has moved from 20 naira to 50 naira, and I want to sell. How do I go about it? What do I need to do? So the first thing is that the investor would approach a stockbroker or approach a stockbroker. All right. Now, and the assumption here is that the investor had bought those shares via an IPO, an initial public offering. So he has a share certificate. Okay, he has a share certificate from the IPO. So, but he wants to now sell those shares. Right, so he needs to get someone to do the transaction for him. He's a stockbroker that does that. Okay, so what does he do? He approaches a stockbroker. He completes the account opening form. Stockbrokers, they are like banks. I mean to use that expression. They're like banks. Just think about your account officer in the bank that manages your account. All right, the stockbroker is like that. He manages your account in the stock market. Okay, so you approach a stockbroker. He opens the account, you fill out the account opening form with your stockbroker. And then there's what is called a mandate, the mandate form. You fill out the mandate form. Now, what is the mandate form? The mandate form is your authorization of your stockbroker to sell your shares or to transact with your shares or to buy shares for you. The mandate. So the mandate is either a mandate to buy, a mandate to sell. All right? So that is the first step. You approach a stockbroker, you open the account form, he gives you the account opening forms. So you can fill it, giving all the details, your BVN, your NIN is one of the requirements, your utility, because you want to do your house address verification. These are some important details you need to attach to the stockbroker's account opening protocols, okay? And then you fill out the mandate form, instructing to sell or to buy. Since we are using company A PLC as an example, the mandate will now be mandate to sell. Okay, so that's the first step. The second thing that happened is that the stockbroker will now dematerialize your share certificate. All right, that's the word. It's called dematerialization. It dematerializes your share certificate. What do we mean by dematerialization? It converts it to the electronic form, because if it is not converted to the electronic form, it is not tenable on the floor of the stock exchange. It cannot be transacted with on the stock exchange. So it has to be dematerialized, all right? So that it can be traded on the stock exchange. So the next thing that happens is that the broker will now carry out your mandate on the floor on the stock market. So he will put out the offer that this so and so person wants to sell his share. This is the price, okay? And then people who are willing to buy also put in their request and say yes, through their own stockbroker, put a mandate as well. The same process, right? Say, Mr. A from stockbroker C wants to sell, okay? Mr. B from stockbroker Z wants to buy. So you give mandate to sell, the other man gives mandate to his own stockbroker to buy. I think that is very clear. So the stockbroker carries out the mandate on the floor of the stock exchange. If you watch the Nigerian news, if you watch the financial reports part, I would like you to go and look at it, maybe on channels or Arise TV. You'll notice they show a hall full of men wearing what's the name of this color? Is it ox blood? Like ox blood sleeves. They usually wear white shirts, and then they wear like ox blood, this kind of road safety, like the vest, but it's ox blood in color. Those men you see, and then they sit behind computers in a large hall. If you watch the financial news most times, you'll see what I'm talking about. And peradventure you have not observed, please go and look at the financial news, either for Arise TV or for channels or for TVC, any of the channels you like to watch. Check during the financial news section. You'll see what I'm talking about. Those men you see wearing those things are representatives of stock brokerage firms. They are stockbrokers. They are the ones that do this transaction I'm talking about, right? They're the ones you are giving the mandate. Okay, I want to sell this, I want to buy this. They will now go to that floor and do the transaction, okay? So with the mandate you have given them, and then the mandate others give to their own clients, they now do the exchanges. That's why it's called the stock exchange, all right? There's exchange of stock. But of course, there's a financial reward or financial transaction that accompanies that exchange of stock. That's why they call it stock exchange, okay? So the broker carries out the mandate on the floor of the stock market. Now, when the broker has successfully carried out the mandate, the broker will now give feedback to the client. Say, okay, I've carried out your mandate. I've been able to sell your shares, right? And then once it tells you that a contract note is issued, right? The contract note is feedback that, see, I've been able to execute your sale. This is the value. This is the total cost. This is what you're expecting in your account, all right? And then the broker sends it by way of what is called a contract note, all right? Now, the broker also provides what is called the CSCS statement. What is CSCS? CS is Central Securities Clearing System, okay? So each shareholder, each person who owns stocks has a CSCS account number. Right, it is unique to you as a person. So anytime you do shares and all of that, the shares you own they're attached to your CSCS number. All right. So the stockbroker provides you with your CSCS statement, and your CSCS statement will reflect that, see, you sold your 20,000 units. I'm still using company Mr. A that sold company A PLC shares, right? The CSCS statement will show that you sold your 20,000 units of this to so and so for so and so value, and that's that. Okay, so all transactions are settled by the CSCS. I told you what CSCS stands for. CSCS is the depository for all your dematerialized share certificates. I think I said that before. It is a depository, so every person who plays in the secondary market has his dematerialized share certificate in the depository of the CSCS. Okay. Now it's important to note that the CSCS completes all transactions in not more than 4 days. So on the day the mandate is executed, give you the maximum of 3 other days. So total 1 + 3. Within 4 days maximum, the transaction should have been completed. And then the CSCS will provide you with a trade alert. Okay, trade alert showing that value has come to you. Having said all of these things so far, I'm sure a curious mind will be asking a very important question. How much capital do I really need? Is this thing really for me? Don't I need to be a multi-millionaire to be a player in the stock market? The answer to that is you don't need to be a multi-millionaire. You don't need to be very successful financially. TWI is about helping people grow financially. So I won't be talking about stocks if you need 1 million naira to start investing in stocks, because it doesn't make sense. Part of the people we expect to have in our audience are people who want to grow financially. So to answer your question directly, or to answer that question directly, with as low as 50,000 naira, with as low as 30,000 naira, you can buy shares. Yes, you can buy FGM bonds. I said it in the last video, with as low as 40, 50,000. You know, one of the beauty of what is happening in Nigeria now and around the world, there's a new drive towards financial inclusion. All right, so there's an attempt to open up investment instruments to retail customers, retail investors, so that the cost of investing doesn't become prohibitive. All right, so you don't need to have hundreds of thousands of naira or millions of naira in your account to invest in the stock market. With as low as, like I said, 50,000, 30,000, 20,000, you can buy shares. All right, you can buy Fidelity Bank. I remember they sold 9 naira per share, and the minimum purchase was 1,000 units. The 9 naira times 1,000, is that not 9,000 naira? So with 9,000 naira, you own a part of Fidelity Bank. Is that not interesting? Is that not beautiful? So I think this is something every one of us should take a shot at. And then some of you might be saying, sir, I want someone to guide me. I want something more personal. I want something more direct. You know, maybe I want personal mentorship. I want guidance. I want someone to hold my hand and take me through the steps. If you're interested in that, we are there to help you. All right, we are there to help you. Please feel free to reach out to the email ID in the description below. I'm sure it will come up on your screen in the course of this video, or call the phone numbers in the description below or on the screen. All right, call the numbers, send that email to the email ID in the description below. All right, so thank you very much. We expect to hear from you. If you have questions, if you have queries, if you have comments, if you have contributions, insights you want to share, you want to add, maybe you're already a player in the stock market, you want to add your voice to our advocacy, please feel free. Share your wealth of knowledge in the comment section. All right, tell us what you know, tell us what you have learned. If there are things we said you are not clear about, ask those questions, bring them in, do your comments in the comment section. We'd like to get feedback from you. Thank you very much. I also like to say, if this video has been good to you, if you feel this video has added value to you, please don't hesitate to subscribe to our channel, like this video, share it with people that you know have need to improve financially. People, maybe you have friends that they make a lot of money, they earn good money, but over time you are seeing that they are not really improving financially. Remember, one of the contents we created earlier, we said that earning a lot of money is not synonymous to being financially successful. If that were the case, people who win the jackpot or the lotteries in the US, who won millions of dollars and eventually file for bankruptcy, they will not file for bankruptcy. So you can earn a lot of money and blow it. You can earn a lot of money and fritter it away. Okay, so share this video with people you know need to have a better control of their financial lives, their financial destinies. Share it with your friends, share it with your family, share it with your loved ones, share it with that uncle that has a job and is asking questions. This salary is not enough. Is this how I'm going to raise my family? Share this video with them. They can begin to invest in the stock market, and you'll never know how life transforming this one video will be for them. Until we see you next time, thank you so much for keeping faith with us. Thank you for keeping in touch with us. Goodbye.